All right, let's get into today's call, which is to talk about feeder fund managers and feeder fund programs. And feel free to put the questions and any comments in the chat, and this will also be available on YouTube. The goal of the feeder funds program is to help the lead GPs, lead sponsors, design a scalable, repeatable, legally compliant capital raising machine. It is a program that's available for the feeder fund managers. Why is this important and why do it now? So right now, the asset prices are at an all-time low compared to the value because of the high interest rate, because of multiple deals are not doing as well, and so on. So that's the economic reason. I was talking to a GP that is a mentee of a big GP that bought very little deals in 2021 and 2022. Like they have a 40-year track record. Amazing. You guys all probably know who they are if I say the name. And they actually say that now is the time to go all in on purchasing, because whoever purchased today will look like a genius 7 years from now. And the only thing standing on their way is the lack of capital. They also tell the mentee to front load as many of the deals as possible. So if you're gonna buy, call it $1 billion of assets, do the 600 million of which in the first 3 years, as opposed to linear, 1/10 over every year over the course of 10 years. Because right now is literally the best time to get into the market. That's the economic reason. And prices are all-time low relative to the value. And investor demand is also all-time low. So it's more important to be able to create a repeatable capital raising machine. Cultural reason on why this is important, why now, is co-GPs are deemed legally not clean. I'm not an attorney, so I'm not here to offer legal advice and so on. What's wrong with the co-GP model is that the co-GPs need to have a substantive role in the syndication, meaning that they need to be actively involved in the management of the asset. And historically, that has not been true. What that created is, if you raise $10 million and you have 5 co-GPs, if the deal does not go well, the co-GPs now are on the blacklist. And the co-GP will be someone that I'm bringing $1 million into the deal. I didn't really do much, but now I am on the blacklist, so I can never be a lead GP anymore. And that's what happened. Basically, co-GP model is a model in which everyone suffers if the deal goes south. Fund of funds or feeder funds specifically separates the responsibility between the two. If the deal doesn't go well, the feeder fund manager, yes, they will lose money, but legally they are protected. Like their own reputation is protected from a legal perspective because they are legally not participating in the management of that syndication. The technological reason is finally because of the advances in legal and CPA and technology, everything is streamlined enough now that you can do this at scale for 5x cheaper the price than before. So they have really reduced the price of creating a feeder fund program. Okay, so that's on the reasons on why. Let's talk about who is it for and why feeder funds and how it works economically and how do you find these feeder fund managers, and then what is it for the feeder fund managers to gain out of it. And finally, we will wrap it up with questions and what sets CFP apart. How are we different from the other feeder fund programs, platforms out there? Feeder funds program, we call it the feeder fund program, is really for lead sponsors who want to have a consistent capital raising deal flow. Traditionally, feeder fund these sponsors, they get their capital out of three sources. One is out of retail investors. Second is out of institutional investors. And third is out of feeder fund managers. Retail investors, they are more, you usually don't have the time to build that relationship with everyone. And they also don't know you that well. It's not through a personal relationship. It's usually through online marketing and so on. So that doesn't scale as well. And each one of those checks is like 100K, 200K, and so on. It's not a million, 2 million. Institutional investors have a different problem. They basically want to check everything. They want to turn over the stones, look at everything underneath the rocks. They have a much due diligence period, and they have their own LPs such that when the economic conditions are not very good, they basically will blank out as well. So it's not as fault tolerant as you think. The third one is the feeder funds. Why do they work? They bring in on average $1 to $2 million each check. And they don't have that as much of a systematic shock during the low economic times because their relationship is based on their way of getting capital is based on relationships. So to give an example, you have my mentor, engineering director at Coinbase as an example. Let's call it Mr. Chen. Mr. Chen is an engineering director, makes about a couple $1 million a year. And he has he invests in real estate. He invests with you through multiple syndications. He knows how you do. He knows your record. And he's being pinged by all the other engineering managers in his tech company of with all this layoff and with all this severance, I don't really know how I can put my money to work. I don't really want to put into the stock market because I feel like we're at the cusp of an AI bubble. I want to diversify. But that relationship, you being the lead GP can never build. You have to build it through this Mr. Chen. And there are two ways you can raise that $2 million. One is you can find, call it 20 engineering managers that are out of Meta. Good luck with that. Or a Mr. Chen that happened to be an engineering director at Meta, and he will raise you that $2 million. Feeder funds is basically a more efficient capital raising machine. The other analogy I'll give is CEOs and account executives. If you are the lead sponsor, you are a CEO of your company. You can keep talking to the customers yourself, or it is time to build a machine that can be the account executives for your company. And so you start focusing on how do you build out that team. Okay. So let's go to the next point on why feeder funds. So traditionally, the alternatives are co-GPs or your investors. And institutional investors aside, those are usually more difficult. That's usually not within the topic of the scope of this talk. With the feeder funds, the co-GPs, there are a few problems with the co-GP model. One is that those co-GPs investors are technically on the same cap table as your investors. And when things don't go well, everyone is on the hook, including all your co-GPs. And the co-GPs, because of the experience in the past few years, they don't like that. Second, they don't feel safe that those investors are on the same cap table. They want that layer of abstraction between their investors. They can reuse their investors for other purposes. They feel like sometimes when they bring in the investors and bring on the same cap table, the lead GP then start marketing to these investors. So they want that economic separation, but more importantly, the legal separation. And the co-GPs, because it is your deal, you are responsible to doing their K1s, You are responsible for checking their EIN numbers, all of the investors' info, and you are responsible for their investors. So it's a very legally muddy space with co-GPs. And that's what feeder funds try to solve. Now, the alternative is out of your own investors. If raising money from your own investor works, then yeah, you don't need feeder fund managers. The problem is that is really hard to scale. Case in point, there are a lot of GPs right now. What they did is they have a whole network of feeder fund managers. They even have a one day conference or get together with all their feeder fund managers. Like treat them as investors with basically $1 to $2 million checks. And they are highly incentivized to work with you way more than the investors are incentivized to work with you. Let me illustrate why that is. That has to do with the economic structure. In general, your feeder fund managers are making about 3x or 4x on their money, depending on their initial investment. Your investors are making about 80%, 1.8x equity multiple or 2x on their money. So the people that are making way more out of the deal, they are definitely way more incentivized to work with you. Your feeder fund managers treat them as a business. Your investors treat them as an investment. Business people are more incentivized to do business with you than people when you sell them on investments. So that's the psychology why feeder funds are easier to work with. So I have a lot of GPs that reach out to me and say, Perry, how can I raise more equity? And I said, yeah, you can raise 100K at a time, or you can do fund manager routes, have a network of fund managers that can raise you $1 million each. You never know about their investors. You shouldn't know about their investors. And but if you build a network of 10, 20, 50 of these folks, you will never run out of money. And that's going to hit your ambition of front loading, buying all the assets in the next 3 to 4 years so that you look like a genius 7 years, 8 years from now. That's how you get ahead in the next few years. Okay? So I hope that everything comes together on why feeder funds play a critical role in raising more capital. Great. If you have any questions, I'm going to pause here for a little bit. How does that sound so far? Put a comment in the chat. And did I miss anything that I haven't covered? Any questions? Go ahead and put it on the chat before I talk about the economic structure. Yes. So Sham asks, are feeder funds appropriate for emerging sponsors or fund of funds sponsors? 100%. Feeder funds are the best legal vehicle for someone who originally wanted to become a co-GP. Yeah. So that's that. Shala asks, can the feeder fund be a foreigner company? Yes, the legal counsel is able to set that up. It will be slightly more expensive due to a variety of reasons, but yes, you can set that up. Are feeder funds known entities, people, and how does the structure get started? A feeder fund is a SPV, is a LLC, and its only purpose is to exist to invest into a syndication or another fund. And we call that feeder fund, it's just SPV, feeder fund, and you will have multiple of those. The lead GP will have multiple feeder funds that raise, call it $1 million into their syndication or their big fund. So the big fund is a LLC. The feeder fund is also a LLC, and there is a parent and child relationship between the two. From a lead GP's perspective, it is literally just a single line on their cap table. Versus on a co-GP model, all their investors are showing up as lines on their cap table. So for feeder fund manager 1 is a single line item on their cap table. All right, let's talk about economic structures. Why does it work? On the economic structure, the Econ 101 is that the LP should feel indifferent investing into your feeder fund, into the feeder fund versus investing as a retail LP in the main syndication. Okay? They should feel indifferent or better by investing into the feeder fund. So a syndication usually has called it 70-30 split. Maybe a 7% cash and cash, then a 70-30 split, up to 15% IRR, then a 50-50 split. So that's the syndication. That's their deal to their investors, to their retail investors. So the feeder fund will do the following. So this is for retail. So this is for retail investors as example. Okay, retail investors. And then they have a class B, called A2. This is for feeder fund folks. This is a $1 million minimum investment. But if you invest a minimum of $1 million, you get a 8% cash and cash as example. And then a 80-20 split up to 15% IRR, and then 50-50 split. Okay. So how can you do it in a way such that the person coming into the feeder fund should feel indifferent about investing into the feeder fund as a normal retail investor? Because that person should get basically a net profit of 7% cash and cash, 70-30 split, and 50-50 split. So a feeder fund could charge a version such as is 80% multiplied by X is equal to 70%, and then X is equal to 0.7 divided by 0.8, and that's about 8.7. So what they do is they do a 7% cash and cash, and then a 90-10 split up to 15% IRR, and then after that 50-50 split. So that's how you charge the waterfall at the feeder fund level. That might sound pretty complicated math, but it's going to be built into our underwriting template so that the lead sponsor can send that template to the feeder fund managers and say, hey, just plug in what your split is, and I know my split, and then that will be the resulting LP split, and make sure that those splits are better or at least the same as if they were to just invest into my syndication directly. Yeah, it's just a reverse. It's basically they invest into a feeder fund, the feeder fund then invests into class A2, and then A2 gets a 80-20, and so everything works out. The LPs will get a 70-30 split when all is said and done. Okay, so that's the economic structure. Now, this is one of the economic structures. You could build even more complicated. So a lot of times feeder funds will charge a 1 or 2% asset management fee. So as you can see, it's nice about feeder funds. It's like it's very clean. It's like you can do what you want. That's independent from what the main syndication does. You have full control about your incentive structure. Okay. Next one is about how to find and where to find these feeder fund managers. That's a great question. The best way to find them is actually your own network. Like your biggest LPs. And just say, hey, if you're bringing $1 million, you're getting a 80-20 split, or even better. And you can bring more folks to it, and so on. And so your biggest LPs might think, okay, I'm interested. Tell me more. How does this work? Because I want to leverage their network, which is their value add, into something that makes them extra money. Feeder funds, if you do all the math, so like a typical LP, or if they invest 50,000, they get back about 100K, so 2x their investment. So 50K their initial investment, and then another 50K is maybe it's a 1.8x equity multiple, but for now, let's assume that's a 2x. But if this is a typical LP, a feeder fund manager is very interesting. Let's say the feeder fund manager also invests 50K, but along with 1 million, they raise along with 1 million. Okay. Oh, absolutely. Thanks, Chala. Along with 1 million they raise, but they will charge a 2% acquisition fee. And when all is said and done, they also make about 80K from being a feeder fund manager. So this 50K comes down to be 100K from their initial investment. 2% acquisition fee is 20K acquisition fee. And then 80K is from their upside from being the fund manager. So they end up making, basically, they turn 50K into 200K. So this is 50K to 200K. They make additional 100K. Now you might say, wow, 100K is so little. This is only for one fund, and this is over the course of 5 years. Usually that takes about 5 years. But imagine from the perspective of that fund manager, they can stack them. They can do 5 of these. They can do 10 of these. Well, check with the legal counsel. When you get to that point, you may have to design a better structure called flexible fund. But for now, they can do this one at a time. Okay. So again, like if you're talking to an LP that is looking to 2x their money versus a business owner that's trying to 4x their money, I think they have a lot more incentive. And they also want to learn. They want to do something. Feeder funds are business folks. Jen, you don't have to be a broker dealer to be a feeder fund manager. This gets into a lot of exemptions as well. So I'm not a legal counsel. There are exemptions that you will use to be compliant. We will make sure that you are exempt before you can become a feeder fund manager. Usually the first point is to talk to a lead sponsor to say, I'm interested, or they will find you, and then you're committed to doing it. Then they will introduce you to the legal counsel, and then you have to check a bunch of boxes, and then you have to answer a bunch of questions, and then that's when you are in. But they have to, the steps are, you have to express interest. A lot of times you almost have to sign a contract, a non-binding contract between you and the lead sponsor to say, hey, I'm actually interested. Let's get to work. That's when we introduce you to the legal counsel. Okay. But yeah, if you need a broker dealer, none of this works. The economics just don't work because there's not much money to be spread here. So that's the economic structure. So your own network. The other way is you can go to things like Race Masters. A lot of these like fund managers, fund launch, Race Masters. These are like mentorship programs. Rockcliffe. There are a lot of fund managers sitting in there. You could also, if you have been a fund manager before, you could go to the happy hours and the meetups and the conferences that they hosted. So there's that. And then there's also InvestSpace. So InvestSpace is a marketplace that you can meet operators and other feeder fund managers. So if you're the operator, you should go on there and check out all the feeder fund managers. If they are co-sponsor, you can also reach out to them because almost all the co-sponsors that I know are converting to become feeder fund managers precisely to basically cover their legal compliance part. Okay. If you watch up to this point, you might notice like, hey, it seems like used to be that when I do co-GP, it's cheaper because co-GPs don't pay anything. They're just like part of the deal. And now every feeder fund has to do their own tax return. Every feeder fund now has to do their own paperwork. And why does it work? Like economically, why does it work now? That goes back to the technological reason. The reason it works is that from a legal counsel perspective, they are creating 5 of those for 5 different feeder fund managers of the same syndication. So they have the economy of scale. And we also require that we at least have 3 to 5 feeder fund managers of the same syndication. The way you being the lead GP if you're interested in the feeder fund program, is that you let us know. Very soon there will be a button that basically on your casual portal, you click that I'm interested. And good news is that you will get a notification, we log in, we're like, oh, okay, this is why you're interested. Let's set up a call, consultation, just so that you understand all the rules of the game. And then you have to introduce us at least 5 feeder fund managers that are interested. Because if you're doing one, then the economy just doesn't work out. No platform wants to do that for one like feeder fund, because setting out 1 versus 2 versus 3 or 5, it's only the inflection point is about 3 to 5 of these for it to make sense for the legal counsel. The good news is that almost all the syndications are longer to raise. They require more capital. A typical deal is a $10 million raise, and the lead sponsor can only raise $5 million. And then they need 5 feeder fund managers that can raise about $1 million each for a total of $5 million, plus their own $5 million for a total of 10. That's how it works from a procedural perspective. All right, let's move on. Let's talk about what does it look like from Mr. Chen, that from a feeder fund manager that is a engineering director at Meta, and why are they in the game? Why do they like this? One is that it's very similar economics as the co-GP model. They do need to pay for the legal costs. They do need to pay for their own accounting and so on, but that all gets abstracted into a very low-cost model. The industry has figured out on how to combat this legal hurdle with a efficient bulk pricing model that makes everyone happy. And in my opinion, the pros outweigh the cons by 10x. You own your own investors. You own your own incentives. You have your own cap table. Your investors never get leaked. You are becoming truly a business owner. If the lead GP doesn't do well, you are not going to be on the blacklist, unlike being a co-GP. And you continue to nurture your investors. That's a huge plus. And all this messy back office stuff, at this point, the technology has gone so good that you can just like leave it up to us to take care of the back office. All right, finally, I want to touch on what sets the CFP apart when it comes to feeder fund management. Unlike other portals that usually focus on the feeder funds themselves, which are all disparate systems, Casual Portal offers a integrated feeder fund experience. For example, if the lead GP uses portal A and the feeder fund managers uses portal B, when A sends the distribution to B, A is the lead GP, lead sponsor, B is the feeder fund manager. B, also every month, A needs to send a investor update to all their investors, including then B will get an email. It is B's responsibility to propagate that email down to their investors. It is B's responsibility to send distributions based on their waterfall to their investors. It is B's responsibility to make sure that they have a profit and loss statement and a balance sheet to do their K1s. And if they live in 2 different systems, because most feeder fund programs, they are just focused on the feeder funds. They don't really focus on the lead GP. There are only very few established, sophisticated lead GP investment management softwares out there. What sets CFP apart is that we can do both. They live in the same system. Feeder fund managers have all the functionalities within their own little portal that includes the favorite document signing, cap table management, see where investors are at every step. They are seeing their own independent deal. That's like any other deal. It just happens to be a feeder fund deal. And that feeder fund deal is connected to the main deal in a very non-obvious way. Meaning the lead GP cannot see any of the investors. They only know that there is a feeder fund coming in. with $1 million investment. That's all they know. But when they send a distribution of, call it 10% to all their investors, the feeder fund manager automatically gets that distribution, and it automatically records it as a distribution, as income or as a distribution or return of capital in the fund admin software. If you click a button, it will create the distribution for the feeder funds investors and ready to be sent out. You still have to click the send button. We shouldn't send it on your behalf. You click the send button. So you can see, because they live in the same system, the money flows seamlessly. All the emails, they will land as a draft on the feeder funds inbox on Cash Portal, and then you can check the email. Make sure that you remove anything about the information that's only appropriate to the main fund or the main syndication. You want to include your own distributions in your email, but most of the updates about the asset are there. So it's really easy in terms of communication. And if one day you want to do a flexible fund, you never have to change portals. If one day you want to do a syndication and you want feeder fund managers to your deal, you never have to change portals. And so now is really the time for us to say, hey, we basically have all the ingredients we need to make an even better feeder fund experience for both the lead GP and the feeder fund managers. Why don't we do that? And so that's all coming up on the portal. And we will be working with a few pilot lead GPs. So talk to us if you're interested in doing feeder fund directly on Cash Portal. We will make sure that we talk to all your feeder fund managers, make sure they're onboarded, both from a legal perspective and also from a technology perspective on how to use the portal and making sure that they're set up for success. So Alberto saying that, okay, book a call. There's great. Okay, cool. And then you guys can all book a call here as usual. So there's the link. All right. So that's what CFP is, what sets CFP apart, which is fully integrated. You don't need a different portal for your feeder funds. Okay. So it's most useful for the lead GPs that are already raising on Cash Portal. So if you're lead GP raising on Cash Portal, I know a few big customers are already looking into it. That's how we thought of this idea, because they're like, I don't want to do the co-GP model anymore. I want to do the feeder fund model. How do I get set up? What's the next step? What can I do? How does it work from a technology perspective? And that is prompted this new feature that's coming up. Cool. I hope that makes sense. And then the other action item is you can go on InvestSpace, check out other feeder fund managers, connect with them, and build that network. But I think most importantly, see within your network which one of your big LPs will be interested in becoming a feeder fund manager. Those LPs are the best feeder fund managers because they are your feeder fund managers. Nobody knows them. Whereas the people they are like, advertising themselves as feeder fund managers, they get poached everywhere, left and right by other operators. So just know that. All right, awesome. Thanks everyone for watching. And I want to leave with this. The next 3 to 4 years, if you do more deals, you are truly going to look like a genius 7 years from now. Be greedy when people are scared, and be scared when people are greedy. This is the perfect 3-year window. This is going to live on YouTube, so this is going to age well, or it's not going to age well. Next 3 years are going to be the best time to do deals. But that's when the hardest deals were getting done, because capital is always going to be a hurdle. Whoever solves the capital problem the next 3 years, you are going to have so much snowballing and so much reputation 7 years from now. They were like, wow, you had it so easy back then. Anyone can make money off good deals. Yeah, little did they know how hard it was to raise money. So keep that in mind. You have reduced your success down to a single element, which is how can you raise capital? And if you're struggling raising capital from retail investors because you feel like you're lacking the network, think again into feeder funds. Because if you have a good deal, feeder fund managers tend to be more opportunity-based than relationship-based. And if you truly have a good deal, you can convince them. So I'll leave you with that. All right. Thanks everyone for watching.